Good afternoon, everyone. Welcome to today's Wednesday market review. It is Wednesday, May 20th, and the markets are doing pretty strong this week. We're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500 through the ETF SPY. We're going to look at the NASDAQ Composite through the Qs, the Dow Jones through DIA, and the Russell 2000 through IWM. Once we finish looking at the four markets, we'll take a quick look at the US dollar. We'll look at gold, oil, silver, and then from there we'll move on to chart requests. Those of you that are joining in, if you have any chart requests, you can always add it to the chat. That way I get an idea of what we are looking for. Let me know when you type in the ticker whether you're looking for a name that you're trying to add long, or maybe it's a name that you're already in. And you're trying to figure out whether you should take profits or stop out if it's going against you, or maybe just looking to figure out what a pattern on a stock says. Anything like that will help me out, so that way when I pull up the ticker I know what you're looking for. If you like the analysis you see here today, you can always follow me on Twitter at StockDarts, where I'll typically post when I'm going to put up a blog post or when I'm going to stream. You can also follow me on YouTube at StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, typically outlining the types of trades that I'm going to take for the week, and often giving you ideas of what to put on your watch list and how to go ahead and trade during certain environments that we usually diagnose during these Wednesday market reviews. Other than that, let's go ahead and get started. The first thing we're going to do is take a look at the ETF SPY. We actually had a very strong close to last week and opened up this week very strong as well. Those of you that were here last week, we were expecting a pullback, and we got it, but it was only two candles. And it was, well, really 2.5 candles, because we had a pretty sharp drop on the 14th, and then, which was, I believe, Thursday, and then eventually recovered it throughout the middle of the day and came back strong. And overall, the markets look like they want to continue pushing higher. I know it feels like the wrong thing right now, but you know, with a lot of states starting to open up again, the market is anticipating that we're going to start getting back to normal. I still think that there's more bad news coming that we haven't seen yet, but until the market reacts to that, we can't really do anything else other than follow what the market's doing. Now, we have an issue, which we've had, unfortunately, for the last month and a half, which is the market continues to trade near very strong resistance, which makes it very difficult to really go ahead and get aggressive to the long side. I think right now the risk reward is still very poor, and with Monday's gap higher, it made it very difficult to trade to the long side this week, unless you're trading very short term or you're trading momentum, because most names gapped up significantly higher, and at that point we're offering pretty poor risk reward as far as trying to go ahead and take a long play. On top of that, the short plays aren't really working right now, as they're slowly climbing up and following the market. So it's despite the fact that the market is strong, I don't know that this is really that great of a trading environment, and we'll see as we move forward how this is going to play out, and whether we're going to continue pushing upwards, and if so, at what point do we get presented with good buying opportunities again? And if we do roll right back over again, at what point is it really worth shorting into this market? As it seems like every time we drop, we have buyers stepping in. Now, I still think that both sides of the trade are open right now. For those of you that are looking to trade long or looking to trade short, I think that there's still plenty of opportunities on both sides. This market continues to be one that is divided pretty clearly between names that were affected by the shutdown and names that were not affected by the shutdown. And as such, there's still very clear pockets of strength and pockets of weakness in this market. And I still think that it's kind of a stock picker's market, where individual stocks are going to move according to their individual stories, rather than everything moving to the overall current of the market. So it still is a good time as far as people that like to dig up trades and start looking for, you know, nice little stocks that they like one way or the other, rather than there are certain times in the market where everything moves together, and whatever stock you're buying is really just to play on the overall markets. But this is not one of those times. This is definitely one of those times where a lot of stocks are kind of moving to the beat of their own drum, and it's up to us to find those areas. And this week I thought it was a little bit more difficult. I thought the last couple of weeks has been a little bit easier, but we'll see what we find as we move forward. But as far as the overall markets are concerned, it looks like the market wants to continue pushing upwards. We are pushing through a very critical level here, which is it's 295 to 296 here. You can see all week we've been challenging it, and today we're kind of inching upwards now. The one thing to keep in mind is that we're we're still doing it very slowly. We're encountering a lot of selling pressure here, and the market is still struggling to really push past this resistance. And if it falters once again, we're likely to get another quick move back down, and likely maybe even come back down and test the lows from last week. But for now, we have to assume, until we see the market get knocked back down, we have to assume that it wants to come up and attempt to breach this 200-period moving average, at least as far as SPY is concerned. We have different technical levels on the Qs and the Dow Jones that we'll look at in IWM. But as far as the S&P 500 is concerned and SPY is concerned, the next key barrier here is this 200-period moving average. Now, I want to go back to the weekly chart, give you a better idea of what's going on here, and why I think this 295 has been such a critical level. You can see it was the ceiling of a range that we spent a good portion of the last couple years in. And even though last year we were kind of breaking past it, we still kind of went back and forth through that level a couple times, and it became a pretty big point of contention before we were able to really rally at the end of the year and have kind of our holiday rally, which kind of continued into the first couple of months of this year. And that's where we are right now. We're really trying to get back into or through that range that we spent most of the couple of years in, and trying to get back to the good times that we had at the end of last year. And that's right where the market is right now. Now, whether we think that the market should be where it was last year or not, that's where it is at the moment. Whether it's through the stimulus or whether it's because it's guessing that we're going to go back to normal, whatever it is, the market is what pays, and the market right now is pushing back upwards to these levels. And so it's up to us to identify trades that give us good risk reward and kind of make sure that we try to take advantage of this momentum. But at the same time, like I said, there aren't a lot of trades right now that are working that give us good risk and reward. And I think that's kind of the key here, is trying to find a way of being able to take advantage if we continue moving upwards without exposing ourselves to undue risk and not chasing the price action higher. You can see that we're still kind of in this broadening wedge. I think at this point it's going to be difficult to really extend these trend lines because it's going to get a little wide. But generally speaking, we're still kind of in this upwards trend here as we continue to climb upwards and really figure out where resistance is. This is something we've discussed over the last 2 or 3 weeks. The idea that the market is still looking for, is trying to figure out the ceiling for our range right now. And it's kind of difficult to really figure out where that ceiling is going to be because we still have, we still have the Qs coming up and trying to print new all-time highs. But as far as the S&P 500 is concerned and the Dow Jones is concerned, I still think that we're basically going to trade sideways into the summer, and we're trying to figure out where the ceiling is. What is it? What is a price that traders are going to consider too high for the S&P 500? And it's probably still going to be somewhere in this 295 to 300 area, but we might need to push past it and then really find out if there's just too many sellers, at which point we'll come back into it. But for now, the next level is the 200. It's not that far away. It's 300. It's about 4 points away. And if we push past it, we're likely going to come up into this area right around 307, 308, which was right at the edge of that range that we started last year. And as you can see, is kind of an important critical point here when we first started this pandemic rollover in the markets. You can see we tried to bounce strongly right at that 295 level. We went a little bit below it and then came right back up, and then eventually we really struggled here in this 310 to 300 area, and that's when we really had the big drop in the markets. And we're right back up to that, and that's the area that we're really trying to push past and establish price action back in there. On the S&P 500, this doesn't look that impressive right now, what we're doing as far as really making headways into a higher territory. As you can see, we've really struggled these last 3 days just to gain 2 points. But the key is that we didn't lose that, and we're not right back down where we were last week. And so until we see a rollover in price action and we come back and we violate this bottom trend line, and see this trend line here, I think is still pretty valid. And I think that's going to be the key now if we're trying to figure out where to go next, is we want to be able to figure out exactly when we roll over. And I think the key is this trend line here. The 20-period moving average is going to be running right alongside it. And so if you're worried about the market turning right back down and heading south, the first point of contention here is going to be this trend line and the 20-period moving average. So we're looking at maybe a price level of 289, 288, and somewhere around there is where we should expect a reversal in the market. Give me 1 second. All right, sorry about that. So that's kind of the turning point. If you're worried about the market heading south, that's going to be the point now. If we do turn around and roll over in the markets and come back down south, well, I think we established again this area around 273 is good support, right? We discussed that last week. If we were going to have a market pull back, that was the level where we were likely to find buyers. This is a very important level, this white dotted line. Those of you that regulars know that this line is basically uh, put here because of what happened in March 11th, March 12th, which is when the NBA decided to postpone their season, and as was really a critical turning point in the our whole response to the pandemic. A lot of businesses and basically all the major sports leagues followed suit and closed their doors as well. And that's when we had a really drastic acceleration to the downside, and that has been kind of a point of contention in several of the market indices, and really was expected to be now a point of support after we were able to push back through it. And you can see we were immediately the market was immediately bought right back up as soon as we touched that level, and we came right back up on the SPY that same day. And so if we break this ascending trend line, we break the 20-pair moving average, then that's the next level of support, and again should likely hold as critical support. You can see the 50-pair moving average is starting to flatten out and starting to even start to slowly curl back upwards to meet price, showing that we've definitely established that the downtrend is over, and price action is now more neutral. Now in the short term, you can see price action is still bullish, but in the intermediate to long term, you see the 200-pair moving average is straight sideways. The 50-pair moving average is still sideways. So despite the recent bullishness, I think overall the market is still ranging sideways. And I think even if we look at the Qs, they're still indicative of a market that's probably going to trade sideways, just using the ceiling of all-time highs as the ceiling for the price range. But I don't really expect us to push through those levels and start a new uptrend. I think we're still just trying to figure out what the ceiling is as far as our trading range for the next few months. All right, so just to kind of rehash what the levels are on the S&P 500. Short term, the 200-pair moving average is critical. That's the level we need to break in order to continue to establish headway into make our way back up towards the previous levels that we traded at earlier this year. If we can't get back above the 200, we're going to challenge this ascending trend line and probably fail. And if we do, our next level support's down here, 273. I think that's all we need to concern ourselves from here to next Wednesday. It's very likely that we stay stuck trading somewhere between about 305, 306, and somewhere in the 280 area. I doubt that we even come all the way back down to 273. But if we do, that should hold a support. If we fail there, there's a lot more room to the downside before we hit our next level of support. But the way the market's trading right now, I don't expect the low 260s and 250s to be in play. Same as I don't expect anything above 320 to be in play. Matter of fact, I don't really expect anything above 307, 308 to be in play. But it's more likely that we come up and test this red trend line right now around 320 than it is we come down and test 255. Now again, I don't think either one of those scenarios is likely, but those are the two really key barriers if we do somehow break out of this range that we've been kind of trading in over the last month and a half now. All right, now if we take a look at the Qs, we'll see a little bit of a different picture. The Nasdaq has been, relatively speaking, stronger than the overall markets, and I think, of course, we discussed that in detail last week, is due to so many of the names, especially the major players in the composite, actually benefiting from people staying at home. Stuff like Amazon, Facebook, Google, they're not going to lose. They're not going to lose business if we're working at home. And maybe Google could lose a little bit from some companies that use them, but Amazon, if anything, has of course seen a big uptick in business. Netflix has of course seen a big uptick in business, and a lot of tech names, a lot of the stuff like Zoom and Citrix has done well because of course they benefit from traders working or people working from home. So the Nasdaq has outperformed, and as we can see, we filled the gap. That was pretty critical. And are almost right back to where we started before the coronavirus really started to take hold. You can see, really, there's just a little skip and a stone throw away from new all-time highs around 237. Now that's still 7 points away. We made it up to about 231 today, so maybe 6 points away or 5 points away. But overall, very close to new highs, and more importantly, has established the price action right back in that same range that we spent the beginning of the year in. Of course, the Nasdaq, like I said, has been the strongest of the four indices. As you can see, the white dotted March 11th, March 12th line, way down here, 193 in the rearview mirror. Not something we're going to have to revisit anytime soon. You can see the ascending channel that the Nasdaq was trading in. We've already pushed past it to the upside, so at this point we don't need to worry about a break back to the downside like we do with the S&P 500. I think with the Nasdaq, if we really want to worry about a rollover in price action, I think the 20-period moving average is really the only thing we can keep our eye on right now. And you can see price action very far away from the 20. So overall, price action very healthy on the Nasdaq and really just climbing steadily. And this has been, something we've been hammering home since March, basically since the lows. That if you want to be long this market, the best place to be long is the tech names. I know it's appealing sometimes to look at some of the beat down names and think to yourself, well, they have more upside and they're worth taking a trade on. But the truth is that those are the names that are struggling because they're losing business. And these tech names are the ones that are doing well because they have not really had a significant dent on their bottom line with people working at home. So I think that this is still the dichotomy that we need to keep an eye on as we move forward. I understand that right now the market is looking forward and is expecting a lot of the businesses that were really hit hard over the last quarter to start to come back to normal. But the truth is there's still going to be a lot of time to recover, and you don't just erase 3, 4, 5 months of lack of income. And so I think it's going to be a while before those names really recover back to the levels they were trading at before we started this whole thing. And so there's still going to be tougher trades to the long side. So in my mind, I'm still preferring to trade tech names to the long side. I'm still not really looking at stuff like the cruise lines or oil names very much because I think that there's still a lot to recover with them. And so I'm still sticking to a lot of tech names now as far as really looking to at least names that I could trust trading to the long side for more than a day or two. Maybe something like some of those other types of names that are really beat up, you can maybe try to take a couple, really short-term swing trades on them. But for now, I think I still trust the tech names, especially for longer-term trades. Now, looking at the key levels on the Nasdaq, particularly to the downside, because I think to the upside, there's only really one level right now, which is the all-time highs around 237. We have this gap that we filled and we're trading above around 230. So very, very short term, this is an important level. See if we hold above that gap. But I think more likely than not, we're probably going to falter and come back into this range here. You can see we're kind of printing a little bit of a shooting star today. You can see as we moved upwards, we have increasing selling pressure. If I zoom in here, for those of you that really like technical analysis, one of the things you want to look at besides trend lines is the candles, right? And if you look at the wicks, which is the little skinny lines on top, you can see them growing as we've kind of inched upwards into the 230s. So there is a lot of selling pressure up at this level, even if price action continues to make headways upwards. However, we have this little candle pattern here. We've got a spinning top, and then we've got a little shooting star and another shooting star. That's showing that there's a lot of selling pressure as we're closing the days weakly rather than strongly. So if we close today near our lows, we can expect tomorrow and maybe even Friday, we can expect price action to come back and test lower rather than continue to push upwards. If we want to close the week strong, then we probably need to close today somewhere at least through the middle of today's price action, if not closer to the highs, at which point we can maybe expect a continuation candle beyond that. That, of course, is still up for debate and depends on how we close today, but just giving you an idea of the fact that despite the fact that we are actually trading upwards, there is selling pressure coming into the market, and even the Qs are struggling to really make headways through what is significant territory here as far as the Nasdaq is concerned. Really not a lot left in order for us to be trading where we were before we started the whole coronavirus crash. And so yeah, that's where we are. Like I said, it's difficult to trade long here. If you think about it, what do we have? Maybe 5 points of upside, and downside, it's like 15, 16 points. So it's not really worth it. Now, for those of you that are thinking, well, then this is probably a good short. It's probably not a good short to try to short tech names right now because they're the names that are finding strength the quickest, and they're the names that are going to be bought up the quickest. So, despite the fact that we're at highs and we're seeing some selling pressure here on tech names, I'd rather see a pullback and then buy that rather than try to short this. Like I said before, there are areas of the market that I think are worth shorting, but I don't think tech names are the ones that I want to be shorting right now. So that's where we stand with the Qs. Like I said, a very critical level is going to be here around 217, which is going to be right around where this ascending trend line would meet price if we do pull back sharply. I think the key right now for a trend shift on the Nasdaq though is the 20 period moving average. Just watch that. As long as price stays above that, obviously it's ascending. Once we lose that 20 period moving average, then we can worry about price action to the downside. But this is going to be the index that is going to roll over the least and is going to have the least amount of selling pressure if the markets do try to correct again. All right, next up we have the Dow Jones. And as you can see, in pretty stark contrast to what we're seeing on the Qs, the Dow Jones trading very, very far away from all-time highs, nowhere near the 200-period moving average, and really pretty close to the March 11th white dotted line that I have here on my chart. So we've been able to make some progress here. We've been able to get over the 50 and the 20-period moving average. We're still kind of trading in the same range that we've spent the last month and a half in. And as you can see, there are some notable laggards in the Dow Jones that are holding back the index. Stuff like Boeing continue to really be a drag on this, and it's really kind of in the same point that I mentioned with the S&P 500, which is trying to figure out where the ceiling is for our price action. We've done a good job of establishing a bottom. I don't think that we're going to go back and test new lows as far as the crash that we had back in March. I think that we've established that that's going to be our lows probably for the rest of the year, probably beyond that. But as far as the next couple of months go, we're still trying to figure out what the top of our range is. I think we're going to go back and forth, and I think that we're not really done testing some of these lower levels that we've kind of left in the rearview mirror. And I think what we're doing right now is trying to figure out where the top of our range is. Now, the thing with the Dow Jones, there is plenty of room to come up and test some other key levels before we hit some serious levels of resistance. And again, I think this goes to show you the dichotomy I was talking about in the markets and why certain names are going to take a lot longer to get back to normal. If you look at the Dow, see the Nasdaq's already back to normal. It's already trading like it was back in January and February. But the Dow Jones still has a long way to go to get back to that range that we started the year at, right? So we're only now beginning to get back to the levels that we traded through most of 2018 and 2019. And we're actually kind of really starting to get ready to challenge the middle of that range, right around 250 or so. There's a lot of room to come back up and still fall short of the top of that range. So the Dow Jones does has room to recover and still kind of stay below that level that we started the year at. So there's more room here for it to make up. But in order for that to happen, we're going to need to see some of the more at-risk businesses start to get more people coming in, right? So we're going to have to see people traveling, using airlines more, going to hotels more. We're going to have to see construction and some of the more industrial type of sectors of the market start to pick up ground and start to get back to work rather than just tech names. And I think if that happens, then we'll see the Dow Jones come up and test the 200-period moving average. And then we'll start to see what happens as we reach the top of the range that we spent the last couple of years in. But for now, as you can see, we actually haven't made new headway this week. We're just kind of stuck in the same range. And this is one of the indices that is likely to come back and retest this 233 level, this white March 11th line. And as you can see, last week we actually broke below it. We did hit the 50 and find support there, and I think that's going to be the key again, is as the 50 comes and starts to turn more sideways, is it going to support price as we move forward? If so, then we can start to really figure out what our range is. But for now, I think that with the Dow Jones in particular, 250 is still going to be a critical level, one that's going to be difficult to push past, and is probably going to be a ceiling for price action unless we see a nice explosion out of the market in the next couple of days. And I think it is possible. I think the Nasdaq is really gearing to test new all-time highs or to push up to previous all-time highs. And if that happens, then we'll see the other indices follow suit. And if so, I think the Dow Jones can push through this 247 that we've been stuck at and start to push towards the 200-period moving average. But I think with the way things are going right now, it's probably likely not to push past that, if it even reaches it. I think with the selling pressure we're seeing out of the Nasdaq in the last couple of days, we might need to kind of hover around this area a little bit longer before we push towards new highs. And then finally we have IWM. And IWM has actually been, relatively speaking, very strong over the last 3 or 4 days. Now, relatively speaking, over the last couple years, it's been terrible. It's been the weakest by far, and has really struggled to keep up with its peers. But as far as the last 2 or 3 days, it's done really well. It gapped very strongly on Monday. Even today, you can see it's up almost 3%, while the other indices are up about half that. And it's coming up and challenging some critical levels of resistance. Now, despite the fact that it's been strong over the last couple of days, in the broader sense, it's still really kind of weak. You can see it hasn't really broken through this gap that occurred back in March. We haven't really come up to the 200 per moving average. If you look at the weekly, you can see that we're actually well below most of the price action from the last couple of years. If you look at 2018 and 2019, we're trading below pretty much all of those benchmarks, except for this drastic drop that we had in the market back at the end of 2018. And we're still really struggling to come up and regain a lot of important price levels. That gap from March is critical. You can see 141 is going to be an important area. We're nowhere near that, and at the moment, really struggling to just kind of make up ground. So, despite the fact that it's been relatively speaking strong over the last 2 or 3 days, it's still kind of a laggard, and it's still going to be the index that we want to watch if we're worried about selling pressure to the downside. Now, I did point out this last week, right? And I think this was a key turning point in understanding that we were ready to bounce last week on Thursday and Friday. This ascending trend line was critical, and we pointed out that we were likely going to lose this white dotted line, the 124 level for March 11th. But if we did, were we going to hold this uptrend? And if so, that would show that the market was ready to bounce. And if we lost that, then that would give us more of a hint that the market needed more time to explore to the downside. Well, IWM quickly found support here. It quickly made its way back up above this 124 level on Friday. So it showed that the market was ready to bounce. So this was a pretty good tell for those that were maybe surprised by Monday's gap up. I think if you look at Thursday and Friday's price action, particularly on IWM, you should have known that the market was likely looking to push forward and make its way back upwards. Now, maybe we couldn't anticipate the news that came out. Obviously, on Monday, we had some news about Moderna and their study and how they had it looks like they're making positive headway into coming up with a vaccine. And that was, ostensibly that was the reason for the gap up on Monday. But a lot of times, the news is really the excuse, not the reason. And I think the market was looking to push upwards and was just waiting for anything positive to go ahead and push upwards. And I think that's what happened on Monday, and that's where we kind of stand this week. Is right now we're looking for reasons to rally, not reasons to turn around and head back south. Now that doesn't mean news can't come out of left field. I think the market is still kind of jittery. We're not in a strong bullish market that's going to ignore bad news. So if we start to see more bad news creep up over the rest of this week, then it could start to, the market could react to that. Because again, the market's not really ready to shrug off everything and push to new highs. I think that we're still in a pretty tedious level here, kind of in a dangerous place where the market can shift back and forth. Now, overall, the buyers have definitely outnumbered the sellers. And I think that as we've seen over the last month, a lot of selling is immediately met up with a lot of buying, right? And so that's why we keep ranging back and forth. And what the market's trying to do right now is push past the short-term range and extend the ceiling of the longer-term range. And I think, again, like I said, that's what we've been doing recently, is we're really trying to figure out where the longer-term ceiling is going to be for price action moving forward. As you can see with the NASDAQ might be really close to all-time highs, but the other three indices are nowhere near all-time highs. And so it shows that more likely than not, the market as an aggregate is going to be trading sideways. There's a lot of room that still needs to be recovered in order for us to really establish a new rally in the markets. I think that's overly optimistic to expect at this moment. We've had a pretty nice V bottom so far on most of the indices, but I don't think that we're going to extend that V all the way to new highs. Maybe on the NASDAQ, but not on the other three indices. So what we're doing, again, like I said, is trying to figure out what's that level that we can't push past. And at that point, then we have a benchmark, and then we'll know exactly where we could take profits going forward. So that's the four major markets. Welcome those of you that just came in. If anyone has a chart request, feel free to type it into the chat. We're not going to spend a lot of time with the U.S. dollar, gold, oil, silver. I think that it'd be more interesting to see what trades you guys are looking at or what trades you guys are maybe struggling with. So if you want, just start typing some tickers. I'd love to see what you guys are looking at, particularly this week where I didn't really find much that I found appealing. If we take a quick look at the U.S. dollar, you can see we had a nice little pullback this week. We're still range bound. If again, the UUP is an index that just follows the dollar as an aggregate, right? And as you can see, we've been able to let go of a lot of that volatility that came in March and February, and we've kind of made our way back to a baseline here. We're at support. If we look at a couple of the individual crosses, I like to look at first the euro. We'll see, and again, the euro made headway. This is based in euros, so up is good for the euro. And as you can see, we're kind of range bound right now. The euro made some nice headway versus the U.S. dollar. We're getting pretty close to a level of resistance here, and likely at some point in the very near future, the U.S. dollar is going to find some strength versus the euro and make its way back and continue to kind of trade in this range. So we have a range that's kind of been established. I think that this descending trend line is not going to be something we need to pay attention to very much longer. I think that we're going to start to look at some horizontal price levels and maybe see 110 as a critical area of resistance that we need to get past in this 200-period moving average. So while this is very strong right now, the last 3 days on the euro, I expect some selling pressure to come in here, and I expect the U.S. dollar to maybe find gain some ground here and start pushing back against the euro. If we look at the euro versus we look at the U.S. dollar versus the yen, we'll see in this case the U.S. dollar has actually picked up a little bit of strength. I think at this point what we want to see is we're trying to establish a sideways range as well. And as you can see, I think this is going to be an important range. I know we kind of went below it, but this is going to kind of probably be closer to the floor rather than the dip we had back down into the 106s. Not a lot of strength coming out of the U.S. dollar here, but at least it's been able to kind of establish a sideways range here. It's got a lot of overhead resistance, and I expect the yen to kind of pick up some steam against the U.S. dollar. And then finally we have the U.S. versus the Canadian. And with oil doing better, it's expected that the U.S. dollar pull back against the Canadian. Now, this is another one. There's a very nice floor here. However, if oil continues to actually do well, then we might see a breakdown of this range. So this is going to be an important turning point here for the U.S. versus the Canadian. Chances are it'll bounce here, and it'll make its way back up. You can see we have a new pattern developing here, and it's probably a pretty tradable range here. However, keep in mind that there's a decent potential for us to break down below that level. So that would be obviously a stop out point if you tried to go long the U.S. versus the Canadian in the next day or two. Overall, I think as you see through the three currency crosses, there isn't a common theme here. The U.S. dollar is kind of just ranging back and forth. You can see it's maybe relatively speaking a little strong or a little weak towards different currencies, and I think overall it's reached the point of a state of equilibrium where it's kind of it's found value, and at the moment there isn't enough of an imbalance to push it one way or the other versus any of the other currencies, which means that more likely than not it'll continue to trade range bound. Now, I mentioned oil. Yesterday was a pretty important day, and I think overall was a very positive day for oil. Obviously, this chart's going to be a while before we could really get back to normal on it. But if we look at we go to a 4-hour chart, right? So that way we get rid of that big mess from a couple months ago. And here's what oil has done over the last almost a month now. And you can see very strong now. The reason that yesterday was important was yesterday was the expiration for I think it was the June contract on oil, right? And we didn't have that crazy drop that we had last month where oil went to negative prices. At this point, oil actually showed increased demand, uh, which is shows that people are the economy is getting back to work. We're starting to increase our demand for energy, and alongside with that was the subsequent increase in price of oil. So we were able to get through an expiration of oil futures with people willing to hold, and with demand for it meeting the expectations, and that way price continued to kind of hold. So that's a positive. I was kind of really curious to see what was going to happen and whether we'd get maybe not oil back in the negatives, but another drop in price towards expiration, showing that we still had lack of demand. But this is starting to show demand again. I think this is important. This was one of the things that I think underneath the surface helped kind of support the market, was the fact that we didn't actually have one of these, a sign that there's still a lot of that there's not any demand for energy because people are still not working. This shows that we're starting to get back to maybe not normal energy consumption, but at least we're starting to increase our consumption of energy, which of course is going to increase the demand for oil. So oil back in the $30 range. Still a long way to go before really it's back to anywhere normal from what we had last year. I mean, I don't mind. I don't mind lower gas prices, and I'm sure no one else really does either. But on the bright side, we do need oil to have some kind of strength in it in order to further the argument that the economy is getting back to normal. So overall, this is a positive. Now, trading oil names I think is still tricky. There are some that have bounced. There are some that are showing promise. I still think a lot of oil names are still worth shorting because we're still going to have this glut of supply, and there's still going to be some overhead supply that's really going to push demand down. I think that there's still, we're anticipating more people coming back to work than maybe are going to. There's been a lot of corporations have already said their workers could work from home for the rest of the year. In Twitter's case, they said indefinitely, and so we're not going to get back to normal anytime soon. It's good to see that we are at least above the levels that we were over the last month. But I think that there's still going to be a lot of selling pressure on oil, and I think a lot of oil names are not going to recover fully yet, and so there's still going to be a lot of counter trend moves and a lot of moves back down coming up for them. Now, lastly, let's take a look at the two precious metals, gold and silver. We can go back to our daily charts for these. As you can see, gold had a very nice breakout. It's still really kind of stuck in, if you think about it, it's still kind of stuck in a trading range. Really struggling with the highs that we printed back in April 13th, April 14th. But this is a nice little bull flag, and it shows mounting pressure as we try to break through to new highs. Gold has been very nice. I like this pattern. As I mentioned before, last week, this was a much better trading pattern than this sloppy mess that we had before that. And so this was definitely a good place to go ahead and try to get long gold as it broke this descending trend line. This is one of the things we looked at last week. Silver as well has done better. Now silver I have not been that excited about, but it had a very explosive move. A big move here from 14 all the way to 16. I think it's losing some steam as it comes up to a pretty important level of resistance here. And is likely going to have to flag here or kind of stall out. So if you went long silver, this is probably a very good point to take some profits. If not, completely close out your trade and wait for the next setup. And I think the fact that silver might stall out here might mean that gold takes a little bit longer to break out of its flag. But you can see they're trading a little bit differently right now. Gold looks like it's still trying to accumulate pressure to push through, and silver has already kind of exhausted that. And is probably likely going to kind of stall out in the near future. So that's gold and silver. They're definitely showing some interesting volatility coming in, and could be interesting trades as we move forward. Silver in particular, that caught me by surprise. That was not one I expected. I was definitely looking at the gold move, but I was not looking at silver because it just hasn't really. It's been kind of lagging gold for a while now, but. With the return to kind of normalcy in the economy, that might mean more demand for silver, and that might be why silver finally started to explode. And it still has a lot of room to catch up versus gold, but it's starting to make way. All right, so that's it. Does anyone have a chart request? I don't have a lot to show this week as far as what I'm looking at. Um, the trades that I was looking at this week have not played out. One of those we were looking at was, as I said before, tech names have been really strong, and it's been difficult to get good risk reward on trades. So I looked for a couple of tech names that were lagging, uh, and they didn't really give us an opportunity to enter. So one I was looking at was Citrix, and we were looking for a reversal pattern around 139. Now I never actually took a trade on this because it didn't give us an entry pattern. Um, and we might still get an entry pattern in the next couple of days, although it's going to be a little bit more suspect because we already broke this level of support around 139. But basically what I was looking for was maybe a couple of hammer candles around this level, and then that way we can look for a push upwards. But that has not been the case so far. It just kind of broke through support, broke through the 50 period. And I definitely want to see a reversal pattern here before I wanted to get long. Now this is kind of an interesting one because, Citrix does GoToMeeting. They're one of the companies that has done really well with people working from home, and this selling pressure might be in anticipation of more people going back to work rather than working from home. Although we haven't seen that on Zoom yet, and this might even be just because Zoom is putting more pressure on them. But overall, this is selling pressure that maybe was unexpected as far as how strong it's been throughout the last couple of months. And so this is one I was looking for a reversal, but it didn't happen, at least not yet. So we didn't take a trade, and that's something important for us. Anytime we look at charts, I always point out that a support level is nice, but you don't want to buy just because the stock is at a support level. You want to find candles that tell you the story that agrees with that support line. So a lot of times when I trade, I'll put these trend lines up on a chart, and a lot of traders, they get antsy, and so they identify a level that they want on a stock, and as soon as the stock hits that level, they buy it. And that's not really a good way to trade. You want to have a candle pattern that tells you, go ahead and buy it. And right now, we're not getting that. And so until this changes, that's kind of where we're stuck on this, and that's something I'm really looking to get involved in. Now, the other idea I had also, so like I've said before, we're still in a market that I think has a pretty big disparity between names that are behaving well and names that are not. So I think that there's still a lot of names out there that are maybe behaving well over the last couple of weeks, but long term are still really struggling with some overhead resistance. So I mentioned before, stuff like, and unfortunately for these are still pretty far away from resistance, but if you look at airlines, you look at Boeing, right? So if you look at where Boeing is, right? This is a name, now I wouldn't say shorted now, but this is a name that still has a long way to go to really get back to normal. There's a lot of overhead resistance. Now, it's probably going to be a long trade as it starts to push upwards here, right? But what I'm looking for is for it to eventually hit a resistance area that's worth trading to the short side. So for those of you that are aggressive, a move past 135 is likely a buy signal. You could probably trade this, but you have to be quick on the trigger and make sure that you don't get caught in a rollover, and just take your profits as it comes up and hits some of these levels around 155, 165. But as I mentioned, there's a lot of these names that are struggling and are only now starting to recover a little bit. And you can see the airlines have not at all. But if you look at stuff like the banking industry, you can see that we had a break of a trend. We started to roll over. Now, we've had a nice recovery over the last week because the markets have recovered strongly. But they're still struggling to really overcome some important levels. On XLF, you can see that we're still at that breakdown point. And a move back below these moving averages is likely going to lead to a move back down to last week's lows. There's still significant overhead resistance. So even if we do get a rally, there's still a level here that's worth shorting. And another one we want to look at is real estate. I think there's still a lot of trouble coming in the real estate industry with so many, there's been a lot of companies and a lot of people that have not been able to pay their mortgages or pay rent. A lot of these people that have rental properties have not been getting any income. And so there's still a lot of stuff in real estate that's going to struggle as we kind of unwind this mess that we have. And so this is another area. You look at IYR. You look at where we stand now. We did get through a pretty critical level here of of support slash resistance around 71, 72. We had a breakdown last week, and then we kind of came right back up. And right now you can see we're trying to break out. So this is very similar to Boeing in that there's a potential for a long trade here if we continue to see a recovery in this area. However, there's also potential for a very nice short trade if we get rejected at price again here at this descending trend line, and particularly once we roll right back over 72, at which point we have a nice gap here to fill all the way to 69 and likely heading lower. So this is a stock that, unlike the overall markets, this is an area that we still have potential good risk reward setup to either side. Now, I'm personally in favoring the short side of this, but for those of you that are looking for a further recovery, and if the markets do recover further, then this could end up being a good trade to the long side. And a lot of times what you'll see is in these sorts of scenarios, it's the false move ends up fueling a pretty strong move in the other direction. So we'll have to keep an eye on that and see whether there's a little bit of a shakeout, but there's likely going to be a strong move here in one direction or the other. And unlike, say, the Qs, which at the moment really aren't offering us good risk reward, that actually has an actionable trade once we get a trigger one way or the other. On this case, we don't really have good risk reward, even to the short side. Some might say, well, this is worth shorting, but it's really not, because we're likely going to see buyers step up at 225. We're likely going to see buyers step up at 223. And really, it's at the point now where we're going to see back and forth here. So it's not really a good short, despite the fact that it's up at highs, and you'll theoretically there's plenty of room to the downside. But because it's so strong, buyers are going to step in and make that a very difficult trade. However, on something like XLF or IYR, we have at least the right risk reward to go ahead and take a trade, right? Because if we take a play to the long side, you've got potential for a move back up of maybe 6 points, and you've got a stop of maybe a point or two. And to the downside, it's sort of the same thing. You have maybe 5 or 6 points of downside with maybe a point of risk. So, this is the kind of stuff that I'm still kind of paying attention to. I think right now a lot of these weaker names are giving us probably cleaner charts to look at. It just depends on whether there's enough momentum for them to kind of make their way upwards. And I think ultimately they're going to make good shorts for us once we find and establish whatever the ceiling is for the market. But overall, like I said, I haven't seen a lot this week that has been interesting to me as far as actionable trades, and so that's kind of where we stand. Like I said, if you guys have anything, feel free to add it. I don't have anything else to really add today, so unless we have any chart requests, we could probably wrap up the stream already. We got like 6 people in here. Hopefully one of you guys has a chart you want me to look at. I think overall, like I said again, the market's been propelled and held up by stuff like Amazon. You can see printing new all-time highs. And I think this is what the market is trying to really follow. Now you'll also notice, like I said, that right now the market is anticipating a move back to normal. You can see stuff like restaurants, right? Like Chipotle. Chipotle is back up to new all-time highs. If you look at retail, something like Best Buy. Now Best Buy is kind of standing out in the retail area, but you can see Best Buy has recovered a very strong amount of its move and has made their way back up. This is a name that I did not anticipate making its way back up into the range that we spent the start of the year at, but it has. And you can see the rejection of price as we got up to the February levels. But overall has held up very strongly, and it shows that the market is anticipating to move back to normal on a lot of these names. They have earnings coming up in a day. It'll be interesting to see just how much they were able to stave off, how many losses they were able to stave off by opening curbside, which is part of the reason they've been stronger, is that they remain partially open throughout this shutdown. And we'll see what happens with the earnings report and just where they end up. But you can see that a lot of these names are kind of showing a price, the market pricing in them getting back to normal. It hasn't been the case across the board. A lot of retail names are still struggling and very low. You can see where Macy's stands. They just, at least in Dade County, they were able to open up again. And I think across the country, they're finally starting to open up stores. But you can see there's still a long way to go before they get back to normal trading prices. Same stuff like Gap. Still trading these ranges that need work, right? So not every not every area of this market is really ready for highs. Um, and I still think some of these are going to be good short trades when they come up and hit resistance. And so that's what I'm going to be watching, because again, my theory is that we're still establishing the ceiling of our range, and so when we hit that ceiling, a lot of these weaker names are hopefully going to be at these levels of resistance, and then maybe can offer us good short trades. Now, like I said, for those of you that are aggressive, you could try to trade these to the long side. I'm not excited about trading them to the long side because it's kind of like the opposite of what I mentioned with the Qs. There's going to be a lot of sellers waiting to sell, and they're not necessarily waiting for the top of the current ranges. So they're going to be trickier trades. So I'm not that excited about going long some of these weaker names, even though I'm anticipating a bounce. I'm anticipating a bounce into resistance, at which point I'll be more excited because I'll like the risk reward better. Okay. All right. So I guess that covers it for today. It doesn't seem like anyone has a chart they want me to look at. Um, like I said, try to keep it. Try to stay disciplined this week, and don't get excited chasing price action to new highs. The best case scenario for us, if you're really bullish, is that we'll have a move up, and then when we pull back, we'll test some of these levels that we've just been struggling at, right? So on the S&P 500, for instance, right now we're kind of testing this level, right? Let's go back to this trend line. Right, so we're testing that level. So the best bullish play we can probably look for right now is that we make a move up to the 200, and then we pull back. At which point, we could maybe look at that as a buying opportunity to go ahead and play an extension back through and towards some of these new highs. So that would be the best risk reward scenario right now. As far as chasing a breakout, I'm not excited about that, and I'm not going to look forward to that. Okay. So that's kind of the plan for the rest of this week. Keep in mind, Monday's a holiday, so the market won't be open Monday, but we'll be back on Wednesday and ready to meet. So have a good rest of this week. Enjoy your long weekend, and I'll see you guys again next Wednesday.